If you're one of the lucky few who still has a pension, you might be asking yourself whether you're really ready to retire. Here's the thing. Having a pension fundamentally changes your entire retirement strategy in ways most people don't fully understand. In today's video, I'm going to walk you through exactly how a pension impacts your withdrawal rates, why the survivorship options you choose for your spouse could be one of the most important financial decisions you'll ever make, and how to navigate the loss of purchasing power if your pension doesn't have a cost of living adjustment. I'm PJ Gibbs, a financial advisor with over 10 years of experience helping families transition into retirement with confidence. Let's dive in. Let's start with some context. Only about 14% of private sector workers still have access to a traditional defined benefit pension plan. If you're in that group, you're in an increasingly rare position. Most Americans today are relying entirely on 401ks, IRAs, and Social Security to fund their retirement. So what makes a pension so powerful? It's simple: guaranteed income. A pension acts as a floor of income that you can count on every single month for the rest of your life. This fundamentally changes how much you need to withdraw from your investment portfolio. Here's a hypothetical scenario to illustrate this. Let's say you need $8,000 per month to cover your expenses in retirement. Without a pension, you need to pull all $8,000 from your portfolio and Social Security. But if you have a pension paying you $2,500 per month, suddenly you only need $5,500 from other sources. That's a massive difference. According to data from Retirable, the average pension in the United States pays about $11,000 per year, or roughly $900 per month. When you combine that with the average Social Security benefit of $2,000 per month in 2025, you're already nearly $3,000 per month in guaranteed income before you touch a single dollar in your retirement accounts. This guaranteed income floor reduces what financial planners call sequence of returns risk. That's the risk you'll be forced to sell investments during a market downturn just to pay your bills. With a pension covering a significant portion of your expenses, you have more flexibility to leave your portfolio alone during down markets, which can extend the longevity of your savings by 5 to 10 years in many cases. Now, here's where things get tricky. Not all pensions are created equal. One of the most critical factors you need to understand is whether your pension includes a cost of living adjustment or COLA. Only about 20 to 25% of private sector pensions include automatic COLAs. If your pension doesn't have one, that means your monthly payment stays the same every year, while the cost of everything else goes up due to inflation. Let me show you what this looks like in real terms. Let's say you retire today with a pension that pays you $2,500 per month. That's $30,000 per year. Sounds solid, right? But if we assume a 3% average inflation rate, which is pretty standard historically, that $2,500 per month will only have the purchasing power of about $1,400 in today's dollars after 20 years. That's a 45% loss in purchasing power. If you live 30 years in retirement, which is very possible if you retire in your early 60s, that same $2,500 a month pension will only buy you what $1,000 buys today. You've lost nearly 60% of your purchasing power. This is a big deal. It means your pension, while valuable, is going to cover less and less of your expenses as time goes on. So what do you do about it? First, you need to plan for this erosion from day one. When you're building your retirement income plan, don't assume your pension will cover the same percentage of your expenses 20 years from now that it does today. You need to build a portfolio that can supplement your pension with increasing withdrawals over time. Second, consider delaying Social Security if you can. Social Security does include an annual COLA, so maximizing that benefit can help offset the fact that your pension doesn't grow. Third, keep a portion of your portfolio invested for growth. I often see retirees who have pensions get overly conservative with their investments because they feel they don't need as much growth. That might be a mistake. Your portfolio still needs to grow to keep pace with inflation and supplement that fixed pension payment. Let's talk about one of the most important decisions you'll make when you retire with a pension: choosing your survivorship option. This decision is critical for married couples, and getting it wrong can have devastating financial consequences for the surviving spouse. Here's how it works. When you retire, you'll typically have a few options for how your pension is paid out. The most common are single life annuity, the highest monthly payment, but it stops completely when you die; joint and 50% survivor, a reduced monthly benefit, but your spouse receives 50% of that amount after you die; joint and 100% survivor. an even more reduced monthly payment, but your spouse continues to receive the full amount after you die. Now, these reductions can be significant. Let's say your single life option pays you $3,000 per month. If you choose the 100% joint and survivor option, that might drop to $2,400 per month, a 20% reduction. That's $600 less every month while you're both still alive. But here's what you need to think about. If you take the single life option and you die first, your spouse gets nothing from the pension. If they were relying on that income to cover expenses, they're in serious financial trouble. So when does it make sense to take the single life option versus survivor benefit? Here are the key factors. First, consider your spouse's health and age. If your spouse is significantly older than you or has serious health issues, the single life option might make sense because they're less likely to outlive you. Second, look at your other assets. If your spouse has their own pension, significant retirement savings, or other sources of guaranteed income, they might not need the survivor benefit. Third, consider buying life insurance. Some couples choose the single life option and use the extra $600 per month to buy a life insurance policy on the pensioner. If they die first, the life insurance pays out to the spouse. This can be a smart strategy if you're healthy enough to qualify for affordable coverage. But for most couples, especially if the spouse doesn't have their own pension or significant income sources, the survivor benefit is a safer choice. Yes, you will receive less while you're both alive, but you're buying peace of mind knowing your spouse will be taken care of. Now let's talk about taxes, because having a pension changes your entire tax strategy in retirement. Here's what you need to know. Pension income is taxed as ordinary income, just like wages from a job. That means every dollar you receive from your pension gets added to your taxable income for the year. This has several important implications. First, it affects how you should sync with your withdrawals from other accounts. The general rule of thumb is to withdraw from taxable accounts first, then tax-deferred accounts like traditional IRAs and 401ks, and finally tax-free accounts like Roth IRAs. But having a pension adds a wrinkle because you're already receiving taxable pension income every month. You need to be strategic about how much additional taxable income you generate from IRA withdrawals. Let's walk through a hypothetical example. Imagine you're 65 years old, married, and have a $40,000 annual pension. You also receive $30,000 per year from Social Security. That's $70,000 in combined income. If you need $100,000 to live, you need to pull another $30,000 from somewhere. If you pull that $30,000 from a traditional IRA, you're adding $30,000 of taxable income on top of your $40,000 pension. Depending on your deductions, you could be easily in the 22 or even 24% tax bracket. But what if instead you pull $20,000 from taxable brokerage account, where you'd only pay capital gains tax on the growth portion, and then $10,000 from your traditional IRA? You'd likely pay significantly less in taxes overall because capital gains rates are lower than ordinary income tax rates. This is also where Roth conversions come into play. If your pension income pushes you into a higher tax bracket, it might make sense to do smaller Roth conversions in years where your income is lower, maybe before you start taking Social Security or before required minimum distributions kick in at 73. There's another tax consideration you need to be aware of: Medicare premiums. Your Medicare Part B and Part D premiums are based on your modified adjusted gross income from 2 years prior. This is called IRMA, Income Related Monthly Adjustment Amount. In 2025, if you're single and your income exceeds $103,000 or married filing jointly with income over $206,000, you'll pay higher Medicare premiums. And guess what counts towards that income? Your pension. This means if your pension pushes you over these thresholds, you could be paying several $100s more per month in Medicare premiums. You can't avoid your pension income, but you can control how much you withdraw from IRAs or when you do Roth conversions to try to stay below these IRMA brackets. Finally, your pension income affects how much of your Social Security is taxable. Up to 85% of your Social Security benefits can be taxed depending on your combined income, which includes your adjusted gross income plus non-taxable interest plus 50% of your Social Security benefit. Your pension is included in that calculation. For married couples filing jointly, if your combined income exceeds $44,000, up to 85% of your Social Security becomes taxable. This is another reason why tax planning is critical when you have a pension. So how do you put all of this together in a coherent retirement income strategy? Let me walk you through a framework that I use with clients who have pensions. Step 1, document all your guaranteed income sources. Start with your pension and Social Security. Know exactly how much you'll receive each month and whether those amounts are fixed or adjusted for inflation. Step 2, calculate your gap. Figure out how much you need to spend each month to maintain your lifestyle and subtract your guaranteed income. That gap is what you need to cover from your portfolio. Step 3, make the survivorship decision. Work with your spouse to understand the trade-offs between taking a higher benefit now versus ensuring they're protected later. For most couples with limited assets outside the pension, their survivor benefit is worth the monthly reduction. Step 4, plan for inflation erosion. If your pension doesn't have a COLA, build your investment strategy to assume you need to pull more and more from your portfolio over time to maintain your purchasing power. This usually means that keeping at least 40 to 50% in your portfolio in growth-oriented investments, even in retirement. Step 5, optimize your tax strategy. Work with a financial advisor to map out which accounts you should pull from each year to minimize your tax bill. This includes considering Roth conversions in low-income years and being mindful of IRMA thresholds for Medicare premiums. Step 6, stress test your plan. Run scenarios for what happens if markets drop, if inflation is higher than expected, or if one spouse needs long-term care. A pension gives you a strong foundation, but you still need to prepare for the unexpected. If you're approaching retirement and have a pension, you're in a privileged position, but that doesn't mean the decisions are simple. The choices you make around survivorship options, tax planning, and portfolio withdrawals will have a massive impact on your financial security for the rest of your life. At Trail of Wealth, we help families and retirees navigate exactly these kinds of decisions. We specialize in helping people who have worked hard throughout their careers simplify the complexity of retirement planning so they can move into this next phase with clarity, confidence, and peace of mind. If you'd like to talk through your specific situation, I'd encourage you to schedule a call with our team. You can also download our retirement readiness checklist by visiting the link in the description below.